let's just run through some of the activity that we saw in the Nigerian stock exchange. It seems volumes still haven't recovered to what the type of levels that we see on an average day in the market, and the market is countering what we're seeing across the board on global emerging markets, which have managed to close and carry positive momentum through for the majority of the week. What do you see as weighing down on the local market right now?
I mean, I think while we haven't seen the much value in terms of the typical daily volume of trades, it's also important to mention that we've seen a significant increase relative to what happened last week. Yesterday, the value of trades increased by about 33%, which is quite material. And if you look across the board, you could say that there's been some pullback of some of the gains we saw last week. And so across sectors yesterday, it was only the food and beverage sector that was up by about 0.3%, while the key drags to the index came from the banking sector, where we saw the likes of Zenith Bank, First Bank, ETI losing value, as well as within the beverage sector, Dangote Sugar and Dangote Flour also lost value, and those were the stocks that really pulled down the index yesterday.
Let's look at asset allocation and your strategy for managing the uncertainty as to where the market is going to go, because as I say, it's really not following and tracking what we're seeing in global emerging markets, where we've had this surge in risk taking. What are your views on investing in equities right now, and what type of allocation would you be putting of your portfolio into the markets?
Okay, I think it's important to kind of look at it from the central themes that would dominate the market in terms of an outlook for the year. And I think largely we've seen a significant increase in the correlation in our markets and other developed markets. And so you would notice that in September, August, for instance, when the US was downgraded, it was about the same time, in fact, that same week, when we saw a significant decline in the all-share index here as well. Of course, you could argue that that happened at the time when the CBN decided to take over 3 of the local banks. But I think beyond the activity of CBN, generally our market has become very significantly correlated with these developed markets. And so the themes that would dominate investors' view for the year would largely rest on the resolution of the Eurozone crisis, which continues to linger despite the various austerity measures that have been put in place. This is also an election year for the US, as well as concerns regarding increase in unemployment in that zone. So generally what we see across is that there's still very high degree of fragility in investors' confidence, and you would expect that to be reflected in asset allocation strategy. So our own view is that within the first half of the year, we're going to approach the market in a very cautious way, putting our bets in the more defensive sectors, i.e. food and beverage, as well as conglomerates. And then even in the building sector as well, while from a pure fundamental perspective, you could say that the stocks are more or less trading around their fair values right now. I think investors continue to find a safe haven in those stocks because of the fact that they serve as a defensive sector when the economy is in the kind of state that it is right now. So really our view is that in terms of asset allocation, we would stay very cautious. As much as possible, we would tend to buffer portfolios with fixed income exposures, because
if you're looking, then can you give us percentage wise, if you're looking at asset allocation and on a percentage basis, what percentage would you be putting of your portfolio into the equity market, and what percentage into fixed income and of course cash?
I think it will be a bit difficult to answer that question broadly, because you then need to answer the question of investors' profile. Is the investor we're talking about, is he a conservative investor? Is he an aggressive investor? If I look at it from the perspective of an aggressive investor, who would typically want to have an all equity exposure, more like, then this is a time where such an investor would need to scale back, bring the equity allocation to somewhere below 80%, and then put some more of that money in fixed income, where you're seeing yields around 15, 16, 17% right now. Whereas for a typical conservative investor that is not very open to the kind of risk that comes with equity, maybe you even want to move your portfolio to an almost fixed income exposure and just right now ride the yield curve.
All right,
So
Jide, Wale.
that I think is the way we can look at it.
It all really depends on, I suppose, the type of appetite that you have for risk right now. We've got Wale from Herrera standing by in studio. He's got a question for you, Jide.
Yes, hi, Jide. It's good to see you. Happy New Year. Well, you've talked a bit about being somewhat conservative about equities, but within the equity space, I heard you say you want to be defensive, you go a bit defensive in the first half. But what are your thoughts on the banks? Many people are thinking that that's the place to be, and that's really where the value is in Nigeria's market today.
I mean, to be very realistic with you, that was the same view that most analysts entered 2011 with, saying that banking sector was positioned to outperform. But as we saw in the latter part of the year, the banking sector reforms really pulled back the performance of the sector. Now, whilst I agree that to a very large extent, those reforms have been significantly completed, and going forward, we should be able to see value come out of the sector, I would still approach the banking sector from a defensive perspective. And so I might place bet on the likes of GT, Zenith Bank, First Bank, those large cap stocks in that sector, because you know that if any shocks were to come into the system subsequently, they are better positioned to absorb it and to still be able to deliver to investors. So within the banking sector, it's important to even kind of separate the banks and for now focus on the top three banks, I would say.
What about investing in the oil and gas sector? A lot of reforms taking place there. Also, the government looking at investigating corruption in the sector. If there's a lot of dead wood, and if there's a can of worms that's really opened as a result of this investigation, what are the risks that you attach to putting your money into the oil and gas sector, and the concerns that might spill over to investor sentiment generally in the market?
I think as we follow the unfolding events at the public hearing regarding the sector, something that seems to come out is, on the one hand, for the general public and for investors, people are getting far better informed about the activities within the sector, which would help in terms of decision making regarding investment in that sector. Something that is also very critical is the fact that, as you also hear names mentioned, it seems clear that the real big companies within the sector, i.e. the oil companies, the likes of Oando, Total, those are the companies that seem to come up positively as a result of this hearing that we have seen so far. So in terms of how this will affect those stocks, I think it will be a positive development for them. We don't think that these companies have been participating in any form of shady deals. And so irrespective of the outcome of the hearing, what it could effect could be that some participants will be delisted going forward, and if those participants are delisted because they don't qualify for some pre-qualification criteria, then it would give a larger market share to the bigger companies, which are the ones that are listed on the stock exchange. So for me, it's a positive development for the sector.